Hey everyone, I'm Jeremy Szafron. If you haven't already, make sure to hit that subscribe button below. We have some great content coming up. Well, today the Federal Reserve has left interest rates unchanged at between 5.25% and 5.5%. Fed Chair Jerome Powell highlighted that although inflation has eased over the past year, it remains stubbornly high and the path forward is uncertain. Here's a clip of Powell discussing the current economic challenges.
My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. The economy has made considerable progress toward our dual mandate objectives. Inflation has eased substantially over the past year, while the labor market has remained strong. And that's very good news. But inflation is still too high. Further progress in bringing it down is not assured, and the path forward is uncertain. We are fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustainably strong labor market that benefits all. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings, though at a slower pace. Our restrictive stance of monetary policy has been putting downward pressure on economic activity and inflation, and the risks to achieving our employment and inflation goals have moved toward better balance over the past year. However, in recent months, inflation has shown a lack of further progress toward our 2% objective, and we remain highly attentive to inflation risks.
Now, following today's meeting, the markets reacted positively. They are more optimistic after Jerome Powell told reporters it's unlikely that the next policy rate move will be a hike. Now, Powell's tone suggested a careful approach to future rate hikes, with traders now eyeing the possibility of the first rate cut potentially happening in November. That, according to the CME FedWatch tool. And joining us to discuss the impact of today's Fed decisions and what it means for the economy and markets is Irene Tunkel, BCA's research chief strategist specializing in U.S. equities. Irene, welcome to the show. Thanks for joining me today.
Hi, Jeremy. Thank you for having me on. Pleasure to talk to you.
Thank you. So many things to discuss. Obviously, we'll talk a little bit about Jerome Powell's presser, in which somebody should have given that poor guy a glass of water. But let's go back a little bit. I mean, today, the Federal Reserve maintained interest rates, emphasizing ongoing inflation concerns. You know, given the recent economic data showing mixed signals, like the contraction in U.S. factories activity, how should investors interpret the Fed's cautious stance on rate cuts here, Irene, right at this moment?
Yeah, I think it's actually quite interesting because the economic picture really is very, well, you may say confusing. Probably a better way to say you can make a case that the economy is strong, but you equally could make a case that the economy is deteriorating. I think that the path Chairman Powell has chosen is to say that the economy is fine. Yes, the march of disinflation has kind of stalled, but growth is okay. He thinks that generally economy is doing well. And I think that the main thing that, reassured investors after he has been pressed multiple times, is the policy restrictive enough? What does it really mean? Hey, Chairman Powell, are you going to raise rates now that inflation has surprised on the upside? And he was like sticking to his party line. I think that he is extremely scripted. And I think that it's very interesting because for someone who started his tenure as the chairman of Federal Reserve, as someone who was committed to transparency of communication, I think that his pressers are becoming more and more sort of scripted, dogmatic. It's very hard to tease out anything new that he hasn't said in a statement. But I think that the good news, he's not planning on hiking rates. The bad news, it's longer for quite a bit longer.
Yeah.
Higher for quite a bit longer.
Higher for longer. I mean, yeah, we have so much to unpack there, Irene. In his press conference, Powell was somewhat dovish, or at least he didn't sound as hawkish as we kind of anticipated him to be, suggesting no immediate rate cuts and focusing on achieving a soft landing. Here's what he said.
I think it's unlikely that the next policy rate move will be a hike. I'd say it's unlikely. Our policy focus is really what I just mentioned, which is how long to keep policy restrictive. You ask, what would it take? I think we'd need to see persuasive evidence that our policy stance is not sufficiently restrictive to bring inflation sustainably down to 2% over time. That's not what we think we're seeing, as I mentioned. But that's something like that is what it would take.
Yeah, I mean, as you said, he was very on brand today, not saying many things, but this seemed like a perfect opportunity for the stock market to take off. I know that there were some positive reactions, taking that risk of a rate hike off the table. Talk to me a little bit about the U.S. equities market and where we're at in this current, U.S. economy.
Yeah, again, it's very interesting because every time I listen to his press conference as a US equity strategist, I always basically look at my phone to see what the market is doing.
Yeah.
And at the beginning of the conference, the market pretty much took off, and I think that was a collective exhale that another rate hike is not on the table, and so equities took off, small cap, Nasdaq, relief. But if you look at what happened till the end of the day, much of that rally has fizzled out because I think that we're back to the same reality. And the reality is really that we have started with expectation of 7 rate cuts in 2024. I was never in a camp that there will be any rate cuts, maybe one, maybe two. And in a way, the market is catching up to that. So we started with 6, 7. Now we barely have one. And what are people discussing? Well, maybe he will do it, he will go once in November or December. And this is a huge change. And if you think about the beginning of the rally, again, back in November, rates have retreated from something over 5%, and the rally started around 3.8. Now we're, changes on a day, 4.6, 4.7. So there's a whole percentage change difference. And nothing that the data has delivered and nothing that Powell has said is going to change, this higher for longer in any way. The market has to deal with this, there is no imminent Fed pivot. Much of that expectation has been priced in. The market has taken off. And I think that now we're facing the hard reality. For a while, the market was ignoring that rates are going from 3.8 to 4.7. But I think that now we really have to sort of grapple with that because nothing in incoming data will change that. So I think that we are kind of cornered. And obviously, high interest rates and higher for longer is not great for the multiples.
Yeah, and do you think that we're going to experience a little haircut on the equity side? Do you think that we're going to see, these highs come down, a little bit of the bubble being popped here?
Yeah, I think that we've seen a little bit of that since beginning of April because it was one of the worst months. I think the worst months this year, something like minus 4%. So there was a pullback. I think that in a world of corrections, that's a baby correction. This is nothing. This is something to shrug off. But at the same time, one might think that, all right, what is the catalyst for the max move up? Because, some of the work that we're doing at BCA, we looked at what is the fair value PE for the S&P 500. Fair value PE is somewhere around 18-19% if we expect, forward margins around 13%, because, your multiples are supposed to be aligned with your future profitability. The market is now trading above 20, so closer to 21. So the market is a little bit overpriced. How do we get this 20 times multiple or 21 times multiple? How do we get to this 5,100? 5,100 on the S&P 500 means that earnings growth should be somewhere above 15%. Currently, the market is pricing 11. So what do we conclude? Much of this earnings growth has already been priced in. We have kind of pulled returns from the future. We are all very used to earning surprises because companies are guiding lower and then every time they report, they surprise. So we're used to earning surprises. We're used to sales surprises. But you have to have a supersized surprise to justify this 5,100 or even more 5,200. So I think that the best case scenario for the market from here is probably range bound. And range bound in a sense that every time there is some hope, that the Fed will go easier, the Fed will be a little more dovish, maybe we'll have a little leg up, maybe there's, some supersized earnings, something, great happening. But then we're back to the same reality. Earnings are priced in, and the monetary backdrop is not particularly favorable, for equities. Everything is interconnected.
Yeah, so a little bit too expensive here.
Sounds a little pessimistic.
Yeah. Well, here, I have a question for you. I mean, Fed Chair Powell has dismissed this whole idea of stagflation. I mean, we talked about it a little bit today. In today's press conference, I think he said there's no inflation.
Be our forecast. That wouldn't be stagflation. That would still be to a very healthy level of growth. And of course, with inflation, we will return inflation to 2%. And that won't be, so I don't see the stag or the inflation, actually.
Irene, is Powell wrong to dismiss stagflation? I mean, inflation has started to climb again, and growth will be slowing down due to higher rates.
I actually love that moment because this was very unscripted moment, and I thought it was kind of fun, as it can be fun within the scope of the Fed or Fed chairman. I think that it depends because the way he thinks about stagflation is 10% inflation and absolutely subpar growth. I think that what we are worried about is just that growth is slowing, inflation is not. So it probably doesn't fit an outright definition of stagflation. But at the same time, I think that what we're seeing is that the last mile of inflation is actually very hard. So getting from this 3 to 2 is actually somehow harder than getting from 6 to 3. And monetary conditions are actually tight in the background. There are some signs that, the Dovish pivot has, unleashed the animal spirits. But if you still think about it, mortgage rates are above 7% now. It's still expensive for companies to borrow. Delinquencies are going up. Consumers are running out of excess savings, and generally inflation hits lower income Americans. I think that Chairman Powell alluded to that. So there's like mounting pressures on, U.S. economy and U.S. equity market. So I think that what we're having is a slowdown, but inflation is a bit stubborn. Stagflation, I don't know. I think it's a matter of definition. But I would just say that I would just say that macroeconomic backdrop is somewhat deteriorating. Of course, there are many reasons that we could be optimistic because perhaps inflation will come down, perhaps consumer is more resilient. So again, this economy is economy of a story you can make. And also it's a two-tier economy where strong companies are doing better than big companies. Wealthier consumers are doing fine, especially with the stock market going up, while lower income Americans are really under pressure to feed their families. So I think that this is two-tier economy, two-tier market, two-tier consumer.
And so the Federal Reserve's recent decision to slow down its quantitative tightening is quite significant. They're reducing the cap on Treasury securities runoff from, I think, $60 billion to $25 billion a month. They're easing the pace at which they shrink their balance sheet. What impact is this going to have on the bond markets? Looking over towards that side then.
Yeah, I mean, they asked directly, Chairman Powell basically demurred that it has nothing to do with the monetary policy, that, interest rates is the main tool, how, the Fed moves the economy. But at the same time, yes, they are decelerating the pace of QT. I think that there are many technical reasons that are behind this because they're worried about the, liquidity and reserves available for banks. Can on the margin that signal that it will add on the margin, it would be less of, sort of drying up liquidity.
Irene, today he was quite on point. Powell has emphasized a lot of patience, but I'm curious, what point does this patience risk becoming complacency, especially if inflationary pressures do not subside as expected? He was very on script today.
Yeah, I think that he's been talking about patience a lot, even in the previous meetings. And what I find interesting in his previous appearances, like even at conferences where he was talking, he's all kind of oscillating between, oh yeah, we will cut at least once, we definitely will go this year, no, we will be patient. This time he only talked about patience. He said that the 3 data points, inflation data points he got this year, have not reassured him that it's the right time to cut rates. But what he said is, I'm not sure if he's being complacent, because he said that there is certainly a risk of overstaying sort of the welcome with the high rates and actually unnecessarily sort of destroying economy or like creating unnecessary slowdown. But at the same time, he said that if we go too early, inflation will resurge. And another point that he made, which was sort of interesting, he said that we're a dual mandate Fed. And the further away with each of our sort of, each of the points of the mandate, the further away we are from where we should be, the more we are concerned. And so now he's closer to the target. So I think he's more concerned about the unemployment. In the past, unemployment was very, very low, but he was further away from the target in terms of inflation. So for a while, we were saying this is a single mandate Fed. I think that we're seeing the emergence of a dual mandate Fed because he said himself that if unemployment were to tick up, or I think he said that growth slows unexpectedly, something along these lines, that they will react. So I do not think they're complacent. In general, I'm not particularly critical of the Fed because I feel that this is an incredibly difficult job that they have, and so far they have navigated it fairly well. Yes, obviously with caveats because no one is perfect, and I think this is a superhuman effort. But I do think that they're diligent and they're doing their best to balance these two risks of being too early and being too late.
Yeah. And I mean, certainly Jerome Powell's trying to be cautious here and not be political in any way with the upcoming November elections. I think his exact quote was, we don't want to, somebody asked him about, remaining unpolitical. And his quote was, we just don't do that. If you go down that road, where do you stop? So I guess my question is, with the November elections looming, the CME FedWatch tool is pricing in that first rate cut the day after November election.
Yeah.
Where is he here? I mean, what a challenge ahead.
Yeah, I think, well, first of all, when he said that he values, Fed independence, how important it is, how it's not affected by, elections, I was applauding him almost like in my mind. I'm like, yes, you said the right thing. I think this is good that the Fed is trying to be independent. Can they? Again, these are humans, but I think that they emphasize how they're data-driven. So let's assume that our Fed is actually a Fed that values its credibility, the Fed that knows that it moves market by communications, so this is important, and the Fed that knows that it has the most power as an independent institution. So first of all, the data is not conducive for rate cuts over the next 3 months. So most likely they don't really have any particular reason to go unless there is a spike in unemployment. If there is a spike in unemployment, no one can accuse them of being political. And if the data moves sideways, and it stays more or less where it is, there is really no reason to go. There is really no need to cut. And so the short answer is, if unemployment goes up, we'll get a rate cut before the election, but that is because of the unemployment rate.
Right.
Otherwise, we probably have a chance for November, December, the best.
Okay, well, let's look ahead here. We saved the best for last on this show, Irene. So let's look a little bit ahead. What's your macroeconomic outlook for the rest of 2024? And are there any particular risks or maybe potential market mispricings that you think investors might be overlooking this year or should be looking out for?
I think that, again, two kind of, I would guess, points I would make. First of all, I think that the current problem at hand is that inflation is stubborn. And that is to a degree, and that rates will stay high for longer, and that guides our immediate sort of tactical asset allocation. And as a sector strategist, this guides how I would position the portfolio. If we look towards the year end, I think there's multiple cracks that are sort of forming under the surface. When I said before that unemployment rate spikes before the election, it sounds a little unreal, when 275,000 jobs created every month. But if you look under the surface at the leading indicators of employment, such as job postings, if you look at hours worked, quit rate, all of that is pointing to a slowdown in the job market. We all know people, white-collar workers, who cannot find another job now. I think that it is much harder for blue-collar workers, service workers to find a job. So I think that job market is actually slowing. And so I think that recession has sort of been delayed, but not avoided. And I think it's the BCA view that we may get a recession somewhere at the end of this year. For the asset allocation purposes, for now, I am kind of dealing with the fact that we had a huge run-up in equities since the end of October of the last year. Most of Magnificent Seven have done well, and there was some correction, and then, investors became much more, sort of careful which companies they reward. But generally, I think that I would say that there is 5 things that I will do at the moment. First of all, if you have allocations to the Magnificent 7 or Magnificent 5 or Magnificent 3, whatever you call them these days, I think it's a good time to book some profits. I'm not saying go underweight. It's very hard to fight the eye. But I think it's a good time to book some profits and take some chips off the table. Second thing I would do just because the markets are very volatile now. You can see it's up, it's down today, even intraday moves were crazy. I think it's a good time to low portfolio beta. So if you're an equity investor, good time to buy defensives. Pick two. Utilities, great. Telecoms, great. Pharma, just as well. But basically the idea is you buy something that will provide you secure earning streams, not going to worry you too much, lowers your portfolio beta. Number three, rates are going to stay higher for longer. So which sectors benefit from higher rates? Insurance is doing great because they benefit from higher rates because they have to match their assets with their liabilities. So they really need to make good money on their fixed income investments. And now, with 10-year treasury at 4.7, it's actually easier for them. So buy something that can benefit when rates go up. But then we're thinking about a resilient portfolio. What if, rates fall just because we have a very disappointing data job report on Friday? What do? You have to have a balanced, diversified portfolio. I recommend buying real estate REITs, but not any REIT. I think that the ones that look interesting are industrial REITs because they benefit from the onshoring trends and they have very, very high occupation. And the second type of REITs I would buy, they're called specialized REITs and they're home to data farms. They will benefit from falling rates, but at the same time, they also kind of benefit from some longer term trends. So this is just like a few ideas. But I think that basically think about inflation, think about higher rates, and think about bolstering the defensive properties in your portfolio.
Yeah, no, absolutely. And well said. Irene Tunkel, BCA Research's chief strategist specializing in U.S. equities, joining us today. Irene, thank you for coming on. This was incredibly useful. I appreciate your time today. Thank you.
My pleasure. My pleasure. It was fun talking to you, actually. I enjoyed.
Well, we'll do this
Thank
again.
You.
We'll do this again soon. Thank you
Will
so
do.
much. Again,
Okay,
that's Irene Tunkel from BCA Research joining us today. I'm Jeremy Szafron for all of us here at Kitco News. Thanks for tuning in. Don't forget to subscribe and like that little video. We'll see you next time.